Okay, for this lecture we're going to start with Chapter 17, which is sampling for balances. The chapter is actually called Audit Sampling for Test of Details of Balances. We'll just call it Short Sampling for Balances, and I think what we're going to do, guys, is we're going to start with, even though there are two very important techniques in Chapter 17, one of them is monetary unit sampling, or MUS. Sometimes it's called dollar unit sampling. That covers about 8 or 9 pages in Chapter 17. But there's another topic towards the back, which is called difference estimation. And it's in a category called variable sampling. There's actually 3 different types of variables sampling, and we're going to focus on difference estimation. And I'm actually going to start at the back of Chapter 17 and start with difference estimation. So let's start with just a background scenario here. We've got this problem here. We're doing sampling for the accounts receivable balance. We sent out 100 confirmations for balances that were recorded at $125,000, but the population is actually 1,000 accounts, 1,000 non-zero balance accounts that total $1.25 million. Now, it's not a coincidence. I just tried to keep the math here, but so you can see pretty quickly that the sample, the number of sample items is 10% of the population, 100 out of 1,000, and then also the recorded balance that we're sampling, $125,000, is 10% of the population value. So that'll never happen, but in this made-up problem, we can do that. Makes the math a little easier for what we're going to talk about. So the confirmation process revealed misstatements that totaled $5,500, and our tolerable misstatement has been set at $40,000 for accounts receivable. So what that means is that we cannot tolerate more than $40,000 worth of misstatements in the AR account. So what do you conclude if you find $5,500 of misstatements in your sample? Well, I think just mathematically, you guys can reason your way through this. You've sampled 10% of the population, both by number of sample items or number of non-zero accounts and total balance, and you found $5,500 worth of misstatements. So if you project your sample onto the population, you would basically estimate that there's $55,000 worth of misstatements. And so perhaps you would conclude that this account is misstated, and I don't think that would be an incorrect assumption. Now, but what do you do if you only found $2,500 worth of misstatements in your sample? Now you project that onto the population, and now you've got $25,000 worth of estimated misstatements. And what do you conclude? Well, that's where statistics is going to come into play, guys, because remember, this is just our estimate of the misstatement. And we may have chosen a sample that is non-representative. So we're going to have to add in some allowance for sampling error here. And so we're going to kind of walk through the steps of how we do that. And we're going to start with difference estimation because I think it's a little bit more intuitive for students. So sampling for balances, guys. Remember, I've told you guys on several different occasions that this is the only test where we actually start calculating misstatements. Right, when we start looking at samples. It's not just whether or not a transaction is misstated, it's by how much it's misstated, if in fact there is a misstatement. So our goal here is to determine whether the overall account balance is materially misstated. And the process is pretty similar to attribute sampling in that we're going to be planning a sample, we're going to be selecting a sample and performing our audit tests, and then we're going to be evaluating sample results. So overall, the process looks fairly similar to what we did in attribute sampling. Now, the terminology, unfortunately, changes quite a bit in difference estimation. So let's walk through this really quickly. And so first of all is our tolerable misstatement, right? This would be synonymous with our performance materiality that we had back in Chapter 9, right? It's the misstatement that the auditor will allow in an account. It's up to us. We get to set this. It depends on our professional judgment and the materiality that we have set for the account. And then obviously we talked about performance materiality being kind of a component of your preliminary assessment of materiality. And it has to be defined, guys, for both overstatements and understatements. Now, obviously, there are some accounts that have it's more likely that they'll be overstated, like assets and revenues, and there are accounts that are more likely to be understated, like expenses and liabilities. So clearly, on most accounts, our tolerable misstatement is going to be kind of one-sided, meaning that we do expect overstatements in certain accounts and understatements in another account. But just because we have that expectation doesn't mean that the opposite won't exist. So we do have to set tolerable misstatement for overs and unders. So make sure you're aware of that. Typically what we do, just to keep it simple, is that we will set the tolerable misstatement for overstatements and understatements at the same amount. But it certainly does not have to be set at the same amount. The expected misstatements, that's our estimated population misstatement. This is what we expect before sampling begins. This is kind of synonymous with our expected population exception rate that we saw in attribute sampling. Typically we'll get that from last year's work papers or perhaps even a small sample if they're not a continuing client. And then we have, much like we had the ARO in attribute sampling, we have a couple of different statistical risks that we will be looking up in tables. And one of them is this acceptable risk of incorrect acceptance. We call it just ARIA. This is a type 2 error. The risk that the auditor is willing to take of accepting an account as being fairly stated when in fact there's a material misstatement. So again, guys, this is our risk, the willingness that we are willing to take of being wrong, or the risk we're willing to take of being wrong, right? Concluding that an account is fairly stated when in fact it's not. This is audit effectiveness, right? That's why we call it a type 2 error, right? This is actually us being wrong, right? We say something's correct when in fact it's not. So if we do that, where our audits are pretty ineffective. This is also a matter of auditor judgment. It does depend on the assessed control risk that we have for an account, and you guys can read about that, how these two are related in the textbook. And then there's the opposite side of ARIA, which is arrear. This is the type 1 error. This is an efficiency error, and I'll talk about that in 1 minute here. So arrear is the risk that the auditor is willing to take of rejecting an account as materially misstated when in fact it's not misstated. So what this means, guys, is that we've concluded that an account is materially misstated, right? But in reality it's not. And so why we call this an efficiency error is, guys, is because what this does is it creates more work for us, right? So our efficiency goes down. We've said that an account is misstated, which likely means that we are going to take additional samples, do more testing to see if we can get to a point where we can conclude that the account is materially correct. But remember, this is us saying that an account is materially misstated. We're rejecting it as being correct when in fact it's not. So that's why it's called an efficiency error, right? Not an effectiveness. All right. A couple other ones. The projected misstatement. The projected misstatement is the total of the estimated misstatement in an account. So we already have a sample. We take that sample and we project it onto the population. You have to understand that it's an estimate, right? It's a combination of what we found and then projecting what we found onto the rest of the population. So it's called a projected misstatement. And then we have these lower and upper confidence limits. Sometimes you'll see them called a lower and upper misstatement bound. So an LCL or a UCL, upper and lower confidence limits, or an LMB and a UMB, lower misstatement and upper misstatement bounds. And obviously, guys, these are the highest and the lowest estimate, right, of the misstatement in the population for a given ARIA. Or acceptable risk of incorrect acceptance. So based on how willing we are to be wrong, right, and likely that's going to be in the 5 or 10% range again, like it was for ARO, right, that will kind of determine how much of an allowance for sampling risk we add on to our point estimate or our projected misstatement. And once we add or subtract that allowance for sampling risk, the subtraction side of it will give us our lower bound, and the addition side of that will give us our upper bound. So again, guys, it's the lowest and the highest estimate of the population misstatement. So here's what it involves. First of all, we have to estimate the error, right? The estimating the error is just projecting the errors to the population. Now, if you've stratified your sample, you have to do this by each stratum. So it's actually turns into several confidence intervals. But we won't use stratified samples. We'll just use a single sample, so we won't have to do that. So, and then we're going to add this cushion, this allowance for sampling error, or what we call shorthand just sampling risk. So it's much like you did in stats class, where you estimated a population mean, and then you added or subtracted some sort of a precision interval, which essentially is just cushion or sampling risk. And then you're just going to compare that estimated cushion to your tolerable misstatement, and you'll draw a conclusion about the population. And then obviously any misstatements that you do identify, right, specific, not estimated misstatements, any identified or known misstatements, you'll have to analyze those and figure out why they occurred, whether there's a subset that's surrounding that particular misstatement, whether it was caused by a temporary employee or fraud, so you just want to investigate any known errors a little further. So this is pretty familiar, this picture here, from what you guys did in stats class. You can see in the middle here what we're going to have is a projected misstatement. Now make sure you understand that this is a projected, right? We calculate our error, right, from our known sample, and then we're going to estimate, right? We're going to project that known misstatements onto the population, and that's what we'll get this projected misstatement from. So it's a combination of known and estimated misstatements. And then we're going to add, right, you have a plus or minus what we call a computed precision interval, or a CPI. We'll add it to get the upper bound, and we'll subtract it to get the lower bound. And so now what we have here, guys, is essentially a confidence interval, right? And then whether we choose a 5 or a 10% area, all right, let's just say we choose a 10% area, what we're saying is that we're 90% confident that the misstatement is somewhere between the lower and the upper misstatement bound, right? Which means there's a 10% chance that it's outside the bound, and that 10% is split in half. So 5% chance that it's above the upper bound, and a 5% chance that it's below the lower bound. And so then that gives you, right, the 100% probability that it's somewhere on your curve. So that's generally what difference estimation is going to do for us, and monetary unit sampling, quite honestly, but that's where we're headed. So what we do, guys, is if our tolerable misstatement is somewhere inside the bound, right? Let's just say we only have one tolerable misstatement showing up. But remember, we have a tolerable misstatement for uppers and lowers, right? Overstatements and understatements. So let's just say that our overstatement estimate for tolerable misstatement is right here, right? It's inside the interval. So what that means is that anytime your tolerable misstatement is inside the interval, right, that means that you're going to have to conclude that this population is misstated, right? You can only tolerate, let's go back to our example and say that our tolerable misstatement was $40,000, right? But we estimate that the highest amount of population misstatement is actually $50,000, right? So clearly 50,000 right? My highest estimate of misstatement is more than what I can tolerate, which was only 40. So anytime you've got a tolerable misstatement inside the bounds, you have to reject that population and say that it's materially misstated. And notice, guys, it only takes one. Your tolerable misstatement for lower or for understatements could be way out here to the left, outside the bounds, right? But it only takes one of your tolerable misstatements to be inside the bounds for you to reject that population. They don't both have to be in there. They can both be inside the bounds, but it only takes one tolerable misstatement to be inside the bounds for you to reject that population. If your tolerable misstatement is outside the bounds, it says, look, my highest estimate is $50,000 worth of misstatements. I can tolerate $60,000 worth of misstatements, so I'm outside the bounds. And now you'd say, okay, this account is materially correct. There are no material misstatements in this account. So that's what we would prefer. We would prefer that we come to the conclusion that the account is not materially misstated. So we want to see our tolerable misstatement outside both the upper and the lower confidence limits. What should the auditor do if the population is rejected? Here are kind of a list of all of the different options we have. Have the client adjust the account balance, expand your testing in specific areas, and then have the client adjust the records. You can increase your sample size, have the client correct the population, and then go and draw a new sample and retest. Determine whether there are any offsetting errors in other accounts, right? And then lastly, you could issue a qualified or an adverse opinion. The most common thing to do, guys, right, is just have the client adjust the account balance. But I would be lying if I told you that that's what we do all the time. What we do very, very often is we increase the sample size, hoping that we get more precision, right? Larger sample sizes give you more precision, shrink the allowance for sampling error, and kind of draw those upper and lower bounds closer to the projected misstatement. So it leaves you a narrower confidence interval and a higher probability of accepting the population. But just be careful with that because, again, just like in attribute sampling, if you increase the sample size and within that new sample you find more errors, you've basically just shot yourself in the foot, right? Because you've done additional work, right? And you've come to the same conclusion that there's a material misstatement. So we've got some efficiency issues there. So this is the more appropriate thing to do, is just come up with an adjusting journal entry and have the client correct the account balance. I think we'll stop here and then pick up in Lecture 2 and talk about variable sampling.